The housing market in 2021 is on fire due to low interest rates, high demand for affordable housing, and low supply of houses on the market. Housing prices have gone up by a record breaking 17.2% over the past year as companies are moving more towards a work from home situation. People have more disposable income on hand, and interest rates have never been lower than they are now. In this video, we will investigate what's going on with the housing market, if the growth in home prices is sustainable for the long term, and if there is another mortgage bubble pop like 2008 on the cards. And we are starting right now. What's going on, guys? Welcome back to my channel. This is Modest Millennial, where we talk about all things money that they don't teach you in school. So if you are new here, please consider subscribing to the channel. So if you look at major housing platforms such as Zillow and Redfin these days, you will find that the number of houses on the market are extremely low, and that the ones that are available to sell are being gobbled up by hungry investors for way more than the asking price of the home. This article from the Motley Fool suggests that the housing inventory stood at just over 1 million homes for sale in the US, which is the lowest number it has been since 1982. This number also denotes only up to 1.9 month supply of housing on the market and really shows why buyers are willing to pay whatever is in their capacity to just buy a home. The study from Redfin found that the asking prices themselves for houses in 2021 were about 15% more than the previous year, and of all the homes that were listed on the market for sale, more than 50% of the houses sold for prices that were more than what the sellers asked for. Low inventory on the market coupled with rock bottom interest rates are the two major reasons why housing prices have seen such an explosive growth over the past year. The 30-year fixed mortgage rate fell below 3% for the first time ever and kept falling to a new record low each month, meaning that borrowing money to buy a home kept becoming cheaper and cheaper while the inventory kept drying out. But the good thing about these interest rates was that the mortgages people sought after, for the most part, were 30-year fixed, meaning that no matter what the interest rate is in 5 or 10 years from now, you, my friend, have your interest rate locked in at what it was when you purchased your home over the past year. Consequently, home affordability went up as lower interest rates meant people could afford to buy a more expensive home to pay off over the next 30 years as their monthly payments stayed relatively low. For example, considering a monthly budget of $2,000 allocated to mortgage payments before the pandemic hit, a 3.65% interest rate could afford to purchase a home worth roughly $372,000. But now, with the extremely low interest rates that we are seeing, that same $2,000 a month can buy you a home worth $407,000, which accounts for almost a 10% increase in what you can afford as a home buyer. Obviously, this meant that more and more people started having skin in the game, as even people with relatively lower incomes and lower monthly payment thresholds could afford a relatively larger or more expensive home than they previously could. This gave rise to more and more people competing for the already bone dry inventory of houses on the market, pushing prices significantly higher as buyers had no choice but to offer significantly more than the asking price to outbid the competition. As people started offering higher prices than what the sellers asked for, homes started selling for relatively higher and higher prices each day, pushing the median home price in the United States significantly higher over the last year. Of course, this is a short-term phenomenon and cannot go on forever. The Feds jumped in earlier this week and pulled back their initial timing for raising interest rates and said that interest rates will now start creeping up by 2023 instead, 1 year sooner than they were initially expected to start going up. Record inflation that is now expected to linger around for a while due to increased demand and the economy opening up has the Fed's concern and is the main reason why interest rates are expected to go up sooner than they were initially anticipated. Once interest rates start going up, the housing demand is expected to cool down as most people that wanted to move would already have purchased a new home, and people that are still wanting to move would reconsider their choices as home affordability will go down owing to relatively high interest rates and will discourage a lot of buyers from paying the additional cost of borrowing money. As more and more people start shying away from buying new homes, the inventory level of available homes on the market will start rising as more sellers add their homes to an already extensive list of homes that nobody is willing to buy, and will start putting downward pressure on the home prices to incentivize buyers to jump in at a price discount. This all seems fairly similar to the mortgage bubble pop back in 2007 and 8 that led to a financial crisis and a massive economic recession throughout the world. For those of you who already are well versed with the '08 financial crisis, you can follow the timestamps below to skip to the next part, but I advise you to keep watching to refresh your memory. So, the seeds of the 2008 financial crisis started sowing between 2000 and 2003 when, due to economic losses from the dot-com bubble, the government intervened and reduced interest rates from 6.5% in the year 2000 to 1% in 2003 to give a quick boost to the economy by increasing consumer spending. This resulted in pretty much exactly what we are seeing these days, which is an upward spiral in home prices as buyers were taking advantage of the lower cost of borrowing money to buy a home. Financial institutions maintained relatively easy lending tactics and were financing people with poor or no credit to help realize their dreams of one day becoming a homeowner, giving rise to a mortgage category known as the subprime lending. These subprime loans were then sold to Wall Street banks, which then derived other investment classes from these loans in terms of mortgage backed securities and collateralized debt obligations or CDOs, increasing the risk associated with already risky subprime mortgages and trying to capitalize on the risk. Eventually, the Fed started raising the rates in 2004, and by 2006, the interest rates were back to almost what they were in the year 2000. Now, you must be wondering, but Shreya, these must be 30-year fixed mortgages, so the payment would stay the same, right? Wrong. Millions of the subprime mortgages were adjustable rate mortgages, meaning that the interest rate on these mortgages would go up as the federal rate went up. Consequently, the monthly payment on the mortgage went up and started causing hardship to a lot of homeowners as they couldn't afford their payment anymore. This, coupled with home prices falling like dominoes due to dried up demand from increased interest rates, meant that a lot of people that paid way over the asking price just to get into a home back in 2003 now had negative equity in their homes and couldn't just sell their home without owing money to their lender out of their own pockets. So guess what? These people started filing for bankruptcy, leading up to eventually their lenders stuck with all these houses that were lower in value than what they lent their borrowers at, and finally one subprime lender after another started filing for bankruptcy, causing a domino effect of failure in an already steaming financial system. And there is more to this story in terms of job losses leading up to more hardships and financial losses that caused the 2008 mortgage crisis. But for the sake of this video, let's just keep it to here and try to relate the story to the current mortgage situation. So there are so many similarities between the housing market from 2003 to 2007 and the current housing market that we are a daily part of. Does that mean there is another housing bubble about to pop in the next few years as interest rates start to go up again? Does that mean that we are on the verge of another 2008-like financial crisis that we can almost smell coming our way? Here is my take on this. The most lethal causes of the mortgage bubble popping in 2008 were adjustable rate mortgages and loose lending practices. The first, adjustable rate mortgage, basically is a kind of mortgage meant to lure you into buying a home that you cannot afford during times of lower interest rates, knowing that your payment as a buyer will eventually go up as interest rates go up. A lot of people, not knowing what they're getting into, bought into these ARM mortgages in 2003, and within just 2 or 3 years, their mortgages started getting more and more expensive to the point where they couldn't afford them anymore. The second, loose lending practices, meaning that banks were basically lending money to buy homes to pretty much anyone they met on the street. Hey, you want money to buy a home? Well, here is $1 million. All you need to do is sign here. During the early 2000s, loose lending practices gave rise to what is called a ninja loan, meaning no income, no job, no asset, no problem, which were then sold to investment firms to form derivatives from these loans, which became the backbone of the mortgage bubble during these years. Now, back to today, in 2021, both of these issues are almost non-existent. Most of the mortgages being signed these days are 15 or 30-year fixed rate mortgages. So when rates eventually start going up, it won't affect payment for people that already have signed a mortgage during these years. So there will be lesser chances of going under. Lending practices have been tightened. Banks ask so many questions these days before lending you money to buy a home. It's almost comical. In 2020 and 2021, to buy a home, you needed or still need to have pristine credit history and a decent amount of upfront down payment. According to this article from Wall Street Journal, about 70% of the mortgages issued in 2020 went to borrowers with credit scores of at least 760, and the median score of borrowers approved for mortgages went up to 786 in 2020 from 770 in 2019. Employment verification and income stability are major parameters to make sure you as a borrower are creditworthy, as banks don't want to assume risk anymore if you were to default on your payments as interest rates go up. In my mind, just looking at these two major parameters being considered before approving people for mortgages, I feel somewhat confident that a situation as dire as 2008 may not happen anytime soon. At the same time, I'm fairly confident that once interest rates start going up again, there might be a slight bit of correction in home prices, as buyers shy away from buying new homes for the time being to avoid high costs of borrowing. It's a very time will tell type of unique situation where we are still seeing record unemployment on one end, but people are still scooping up mortgages left and right. That being said, here is my not financial advice to you aspiring home buyers out there. Prepare a budget for what you can afford as your payment and don't overpay a penny beyond that for your next home. Paying more than asking is a relative phenomenon, and you should only consider paying maybe a few grand above the asking and not go crazy by paying 50 or 100 grand more just to be competitive. Make sure you have decent credit when asking for mortgage approval, cause chances are that you may not get approved with a poor credit. And finally, be prepared to look at homes in areas outside of your general liking, as prices for similarly sized homes outside of your general township may be relatively lower and you may end up getting a better bang for your buck. Thanks so much for watching, guys. I really appreciate it. And as always, don't forget to like this video below and subscribe to my channel for more personal finance videos. Also, if you are tired of just watching me in this small frame, please follow me on Instagram, where I share spicy insights of my personal life and how I save money pretty much on a daily basis. Alright everyone, see you again soon. Shut it down.